You've probably heard in the news, the Fed raised the interest rate by 0.25%, and immediately stocks fall, the dollar rises, and experts talk about the risk of a recession. But why does a decision by the US Central Bank affect the whole world? Welcome to the Self and Biz Hub. Today we will explain simply what the Fed is, how interest rates work, and why it matters to each of us. The Fed is the Federal Reserve System of the United States. Simply put, it is the central bank of America. The Fed rate is the main interest rate in the U.S. It shows the rate at which banks can lend money to each other for very short periods, usually overnight. But how does this affect consumers? And why do banks lend to each other? Let's explain. In the U.S., as in other countries, every bank must keep reserves, a certain amount of money in accounts at the Fed. This is necessary so the bank can meet customer withdrawals or make payments. If a bank does not have enough reserves at the end of the day, it borrows from another bank overnight. If a bank has too many reserves, it can lend them to another bank and earn interest. In other words, banks trade their excess and deficit funds with each other. This is the U.S. interbank market, and it sets the tone for all other interest rates in the world. How does the Fed rate come about? The Fed rate is the interest rate at which banks lend these short-term overnight loans to each other. For example, the target range might be 5.25 to 5.50%. That means banks lend money to each other for a very short period at 5.25 to 5.50%. For individuals and businesses, banks add their own margin on top to make a profit and cover risks. For instance, if the Fed rate is high, 5.25 to 5.50%, a bank might offer a mortgage at 6 to 8%, or a business loan at 7 to 9%. Loans become more expensive, and businesses and consumers borrow less, buy less, and spend less. The economy cools down, and investments decrease. This is done intentionally to curb high inflation. If the rate is low, 0 to 0.25%, a mortgage or business loan might be 2 to 4%. Loans become cheaper, people and businesses borrow more, spending increases, and the economy accelerates. A simple example. Imagine the Fed raises the rate. The bank where you have a mortgage says, "Sorry, but instead of 4% per year, it will now be 7%. As a result, fewer people take loans, demand decreases, and prices rise more slowly. If the Fed lowers the rate, loans become cheaper, and people buy homes, cars, or start businesses more actively." How does this affect the whole world? This is the most interesting part. This is where it becomes clear why everyone, from a Wall Street investor to someone in any country, watches the Fed rate so closely. First, the US dollar exchange rate. If the Fed raises the rate, the dollar becomes stronger. For example, 1 USD can buy more of another currency, like 1 USD equals 1.1 EUR. This means that imported goods in the US, cars, electronics, clothing, become cheaper, while American goods become more expensive abroad. For other countries, paying back debts in dollars becomes harder. If the Fed lowers the rate, the dollar weakens. For example, 1 USD equals 0.9 EUR. This means imported goods in the US become more expensive, while American goods abroad become cheaper. Other countries can more easily pay their debts. Second, stock, bond, and cryptocurrency markets. High rates, money flows into safe investments like bonds and dollars. Risky assets like stocks, cryptocurrencies, and gold fall because fewer people buy them. Low rates, money seeks higher returns in risky assets. Stocks, cryptocurrencies, and other risky investments rise. Third, commodity prices: oil, gas, gold, wheat. Most global commodities are priced in dollars. If the dollar is strong, it is harder for other countries to buy these goods. prices for oil, gas, metals, and wheat often fall. If the dollar is weak, these goods become more affordable. Prices can rise. Fourth, capital flows into or out of developing countries. If U.S. rates are high, investors pull money from other countries' markets and invest in the U.S. because it's safer and the interest is higher. If rates are low, capital flows out of the U.S. into other developing countries because the potential returns are higher there. Conclusion: the Fed doesn't just manage the U.S. economy. Its decisions ripple across the entire world, from national currency exchange rates and supermarket prices to the cost of loans, investments, and even cryptocurrencies. In fact, the Fed acts like a global central bank, even though officially it only operates for the United States. Support our channel so we can keep creating more useful content for you, and be sure to write in the comments which topics you'd like us to cover in future videos.